Charandeep Singh and Varun Daga join us. Let's welcome both of them. Let's take our conversation forward. Last 1 year has been quite rewarding for equity investors. Their fund has given a 67% return versus Nifty 52 and the small cap index, which did some crazy things. Charandeep, Varun, good to have you back. Thank you for joining us. Lot of confusion, Charandeep, in the world. 3 months ago, markets were debating inflation and a scenario of higher interest rates. Suddenly, we are now getting worried about slowdown. What to your mind is happening in the real world?
First of all, good morning, Nikunj, and good morning to all your viewers. Thank you for having us back again. It's been a while, but we're excited to be here this morning. I think, the first thing I would tell all the viewers is that, try to ignore the macro headlines as much as you can. At least to us at Girik, we're so mired in our process and so focused on our processes that we tend to ignore a lot of the noise regarding interest rates, regarding taper tantrums, regarding all the news that hits the headlines. Because it's next to impossible to sift through these wads of data and headlines that hit our tape every morning. I don't think they have much relevance to the ultimate outcome of what your stock does. They can definitely cause certain short-term gyrations and create volatility in the near term, which if you are an investor, you have learned to bear by now. In fact, I would say that in the event you get corrections because of unexpected bad news that hits, it's always going to help your equity returns if you're a good stock picker.
Varun, let's talk about the positioning and the positioning where you currently are investing for your clients. Large part of your portfolio positioning is centered around IT. Let's talk about IT, given that there is a lot of excitement in the old economy IT, in the old IT companies and the new so-called consumer tech companies. What do you make of the IT numbers which have come out so far?
Thanks, Nikunj. Thanks again for having us. I think, Nikunj, very clearly, IT has been the leader of this bull market. And, as we always spoke, that every bull market has a leader. And for this one, that it has been IT. And it's just not the IT on the software side, but also on the digital side, especially on the product side. So there are a lot of these companies which have been coming up on our screeners, and they're still on top of it. Numbers have been phenomenal, right across from the large cap IT, like Infosys or TCS, and going down to smaller IT names. So we are very impressed with the numbers. And what the good part is that they were never so expensive, and they continue to do well. They continue to accelerate in terms of numbers. The digital part of their businesses are still growing at a very fast pace. And we are still very, very happy about the sector.
So Varun, what is the right way of looking at valuation for IT companies? Yes, the base effect is there. Yes, the growth is there. Even a company like TCS is confident of maintaining double-digit growth on a large base. Now, most of the IT companies are trading at P multiples which are north of 25. What is the scope for IT stocks from here? Because market price is a function of EPS and PE. Do you think bulk of the PE expansion is behind us and now it is only a play on EPS? And if that is the case, then IT stocks should give maybe single-digit returns from here.
Yeah, Nikunj, I think that's a very, very good question, because, if you look back in history and look at the consumer names, they were also growing at very similar pace, back in 2011-12. And nobody ever thought that these guys could get a multiple they're getting today. So I think it's anybody's guess. You can't say that, okay, these companies are already at 20-25 multiple, they can't get to 50 multiple, because compare it to a consumer name like a Nestle or a Lever. These guys also have great governance. They also have amazing cash flows, very stable earnings, and now with the pandemic, we also know that they are pandemic proof. So a lot of large money will move to IT and is moving to IT. So I mean, it's very difficult to say that they can't get higher multiple, or it's probably wrong to say that they can't get higher multiple. Yes, we are not used to it in the past. We've seen them at teens multiple. That's why we are not able to uh, we are not able to forecast it. But we've seen that with the consumer example, it's possible as long as the earnings acceleration continues. I think they should hold or probably better the multiple.
Right. Sandeep, one stock which has done phenomenally well as per the data what I have about your declared portfolio is Angel. Now let's spend a minute and try and understand that why markets are so gung-ho about buying brokerage stocks. Now broking industry is a competitive industry. The real disruptions are happening in that space. This is an industry where yields per se are coming down. So it reminds me of telecom, which is that yes, the top line growth, data consumption will grow, but the commission structure and disruption will always keep profitability under check. Why are markets so gung-ho about brokerage stocks, platform companies, even depositories like CDSL or exchanges like BSE?
Yeah. So, Nikunj, this is a good question. And it's a question we had as well. When we actually made the investment in angel broking and CDSL, maybe a little earlier than this time last year. See, they've surprised us too. But, let's go back to the thesis, the basic thesis of why we even decided to enter into these some time ago. And, I'll just caveat it by saying, please don't construe any of this as advice. Everybody should do their own work. This is just Girik's own view. That you see, when we started looking at brokerages, we looked at angel broking, we looked at ICICI Securities, we looked at the whole brokerage sector, little over a year ago, just after Angel's IPO. And what we noticed was there is an element over here of digitization coming in. So what we were finding was that just a cluster of broking firms, maybe 3 or 4 of them, most of these are unlisted, by the way, names like Upstocks and Zerodha, and Angel had just come out with an IPO, by the way. These guys were incrementally taking bulk of the market share in the broking sector, and they were even healthily beating the ICICI Securities and the HDFC Securities at a game that they had ought to win, right? And we tried to dig into what's the reason for this, because you see, we also had the same bias about broking companies and depository companies, that these are deeply cyclical, which they can be. Broking used to be 50 bips 20 years ago, now it's next to zero, right? And what could really be the cause for any triggers in stocks such as this? And what we found was that the industry was getting very clustered. There were maybe 4 or 5 names that were taking bulk of the incremental market share. If you look at Angel today, it's still taking almost 20% of the incremental market share. We try to understand what's really the reason for this. And we found that because of digitization in India and the easy availability of data communication in India, people or broking firms that have been able to adapt to the new way of doing business at virtually zero fees are outgunning the traditional players. So it really became a winner-take-all kind of game, and 4 or 5 guys took the entire market by storm. In fact, Angel is adding maybe 4 lakh accounts a month, which is up there with just 3 or 4 other broking firms. These guys have set up engines, digital engines, to go out and acquire customers in the smallest of towns. So they have been technology enabled, and their digital platforms have been able to acquire customers in a cost effective and scalable manner, which absolutely nobody was able to understand and call easily because of these traditional biases that people have about broking firms. This was about a year ago when the market cap was no more than 3,000 crore. Similarly, CDSL's market cap was around 4,000 crore at the same time. Of course, they've done very well from there. And the engines continue to chug along. And yes, you're right, they are cyclical businesses, but they've had a huge structural element to them in terms of benefiting from a huge customer acquisition strategy that has played out in their favor. When it comes to CDSL, you'll find that, again, a digitally enabled platform, all along considered a boring, slow-growing utility. But the one thing they did was they were able to tie up with the low-cost brokers such as Angel, Zerodha, and Upstocks. And if you look at the historical market share, CDSL was always a number 2 player. But if you look at the incremental market share and all the benefit that has come from zero-cost broking or low-cost broking, it has pretty much all gone to CDSL. So they were very quick to take up that challenge and that opportunity, and they were and have benefited from it, and they continue to do so because their numbers haven't changed. I mean, they acquired something like 60 lakh customers in the last quarter. So that's really the story behind the whole thing.
Okay, fair enough. Varun, wanted to get in your take as well. If one had to look at companies that have thrived at this time of the pandemic, it could be within the logistics space as well as, diagnostic companies that have done well. Are there any particular areas or an emergence of a new category that you believe has, pivoted and capitalized on the pandemic in a sense?
So, we always go by our screeners, and what we see is that, it's just the continuation of this whole trend in technology companies, IT companies, chemical companies, agrochemical companies. I think they're really leading from the front. Then you have emergence of companies like metals we talked about. They are doing well and they continue to do well. What else we look at is, or what else we are seeing is some companies where there are government transformations or reforms, like what we saw in the PLI. So there are companies, which are benefiting from this whole PLI scheme, and, in different sectors, it could be electronics, it could be pharma, it could be chemicals. So there will be companies which will benefit from that theme. Always when there is a government reform, it does have an impact on companies who can benefit from that. So that's one part. The other one is, of course, we've seen a lot of this, in the market, like the ethanol theme, and many of these companies will become green energy companies. We have to obviously see how they execute and how this whole plan pans out. But it's obviously very exciting to see that there are reforms that are being made, and which could change an industry for good. So we are these are the areas we are focusing on, and we are always looking for new emergence of sectors. But usually what we've seen is we find that in a little bit of a corrective market, where new emergence of new sectors which are making highs in a bad market, and that is something which we look for. But for now, it's just the continuation of the old trend.
And Charandeep, where within some of the traditional consumption names or QSR themes would you advise investors to look at closely?
So, again, let me caveat that, saying that we're not going to be able to advise investors to buy anything, but because investors need to do their own homework, we have compliance restrictions on advising people. But what I would say is that, yes, QSR is a good theme, consumer is a good theme. I think one must be very aware when they look at a QSR company that, it's able to not lose its relevance with time. I think the one QSR name that sticks out, which has done very well historically, is Jubilant Foodworks. They're an out-and-out leader. And I think the interesting thing about that name, and which is one reason why we've always liked it and owned it from time to time, is that, they today have close to 40 million registered users on their app. And they were a very early enabler and adapter of technology. So to disrupt somebody like that won't be easy. You have a Zomato IPO coming in, and today there are restaurants being born that actually rely on Zomato. They're happy to pay them that 20% because they can't do without them, right? But when you look at someone like a Domino's, they've got their own digital stack out there, which gives them direct ownership of their customer. And they're able to not only give their customer a direct experience, but they're also able to save that money, So I think that there is one has very, very challenging times, especially very exciting times, because that whole QSR space is moving along in a very fast manner. So, guys like Domino's, very well established, very good names. Some of the larger QSRs as well, the Burger Kings, McDonald's. Obviously, these guys have a right to win, and they have the capital and the resources to go out and make sure they scale and keep a hold of their customer directly and provide them a great, exciting experience. But one must, when you look at a QSR, one must not ignore what the Zomatos and Swiggies of the world are doing, right? So one must really understand the business model and understand where they sort of fit into the ecosystem before one makes an investment call.
You like a very interesting name in the pharma space, Ajanta Pharma. This is that multi-bagger of the last decade where the stock added a zero in its stock price. Haven't seen anybody own Ajanta Pharma in a while. Who wants to answer this one, Varun or Charandeep?
I'll let Charandeep answer that.
So anyways, you see, Nikunj, this is something, again, we've owned from a while. It's almost been a couple of years, if I'm not mistaken, or sometime last year. It's actually done better than most pharma stocks in India. If you see, the entire pharma sector has been a laggard, relatively speaking, in the last 1 year. So other than a couple of names that have done well, this is one of those names that has done pretty well. What we like about it is the earnings growth story. See, the thing with Ajanta has been, historically, it's been a very well-managed company. And, they've always been able to find growth through all their initiatives. So, not only is their domestic business and their emerging markets branded business very strong, the kind of earnings growth it keeps throwing out is far superior and higher than the rest of its competition. Also, in terms of its US business, it kind of went wrong. And that's why the whole story sort of, fell on its head a couple of years ago, because the US market got very crowded and there was disruption in the distribution chain then. There were major US FDA issues. They seem to have got through them pretty well. They had made the investment upfront and now they seem to be getting rewarded for it. So I think there's many earnings tailwinds in it. And, hopefully they should continue. And that's the story behind Ajanta for us.
Varun, so if I look at your portfolio, it is not inclined to a particular theme per se. There are funds which say we only want to buy quality regardless of the price. There are some funds who say we only play value and we want to buy stocks which are trading either below book or at sub 20 PE. You own a Jubilant Foodwork, which is expensive. You also own steel companies, which are cheap and cyclical. So what is the idea here?
Sorry, I got disconnected, Nikunj. Can you repeat the question?
No, I'm just trying to scan through the positioning. And the positioning, Varun, is that you are not claiming that you will only buy quality stroke master franchises or you will only take a deep dive into quality. There are portfolio managers who say we will not buy steel or cement, but we will buy the good quality master franchises. There are funds, large and respectable funds, which say we do not want to buy expensive PE stocks. We only want to buy stocks which are either trading below their book or are perhaps trading at P multiple of less than 20. In your portfolio, you own a Jubilant, which is expensive on traditional yardstick, but you also own steel, which is cyclical and cheap.
Yeah, no, I think, for us, it's really following a process. We've always talked about stocks that are coming up on our screeners. Of course, we want to buy great franchises. We want to buy companies which are run by phenomenal managements and which has an element of, that probably 5 years or 10 years down the line, people think that, oh, it's a great business. See, for now, if you look at many of these companies which people claim that, oh, wow, these are master franchise, probably 10 years ago, they were not in that bracket or they were not in that segment. It's because of the recent run up and because we are so in love with some of those companies, we say that they're amazing companies. But we've seen these cycles come again and again. Look at 2007. If you didn't own an SBI and an L&T, people would laugh at you, right? Today, who owns an SBI and L&T, right? Everybody owns the Nestle's or the Asian Paints of the world. So, there are great companies in every sectors. There are great companies. Yes, I mean, if you look at Tata Steel, they have made their share of mistakes going into international markets, bad capital allocation, but a lot of that can change. Is it a cyclical industry? Yes, steel prices are cyclical, but is the demand secular? Yes, the demand is very secular. The India steel demand will keep growing, has kept growing, and Tata Steel is the largest steel manufacturer of the country, and the sector is really getting consolidated. So for us, what's important is that can it become that darling of the market over a period of time? Maybe it is not today, but over a period of time, can it become that master franchise which could throw out enormous amount of cash and to its shareholders and really reward shareholders? We are not in that bias and we are not in that you know bucket where we try to say that, oh, these are great companies and these are bad companies. I think again those are just biases. I mean, we've seen a company like ITC was the biggest compounder, and then for the last 5 years had done nothing, right? And not many people own it today. So companies can go into cycles. We've seen a company like Sun Pharma was in every portfolio in 2013. Everybody had to own it, right? From 2013 to 2015. And then it's done nothing for the last 5 years. So every company, every sector can have cycles. Yes, if you have time frame for 50 years, then you could own many of these, but each of these companies can go into a cycle for anywhere between 5 to 10 years. And then do you have the patience to hold it without making any returns? So for us, focus is where can we make money, which are the sectors that come up on our screener, and we believe the sectors that come up on our screener have the highest chance of making money. We are not biased to any sector. We are not going to label any sector as cyclical uh, or secular, because we know that there could be companies which are today sounding cyclical can become very secular. Look at 2007. Real estate was the most secular sector. People have to buy homes. Real estate companies can never go down. And today, what happened to them? Many of them are probably bankrupt or don't even exist. So the point is that every sector can have cycles. And can you catch the meat of that cycle, or the main part of that cycle, to make the best investor returns for your investors, and of course hold the best quality company. So we believe in buying leaders. We'll never go into the third, fourth, fifth guy. So the idea is stick to the winner, stick to the leader, because the leaders will always surprise, and of a leading industry.
All right, Charandeep as well as Varun, it's been lovely having you both on board. Many thanks for joining in and sharing with us your outlook on the markets as well as individual sectors of opportunity and your portfolio strategy.